If you're looking to invest into some growth stocks, but you don't know where to start, and you may be wondering if you should put your money into this one, that one, but maybe you don't know if it's going to go up or down or left or right, well, a great place to start investing into some growth stocks would be some growth ETFs. And some of the best growth ETFs on the market are some of the popular names you may have heard of, like SCHG, QQQ, and VUG. And in today's video, we're going to break down these 3 growth ETFs to help you make a better decision and to see which one fits in your portfolio. Hey guys, my name is Steve and I run the Frugal Expat website where we try to help people to save more and invest better. And if you like this content, make sure to hit that like button and subscribe, and we'll get right to it. So these are 3 of the most popular growth ETFs on the market, and it makes sense because it's an easy way to invest into growth companies. It's an easy way to kind of get started, and you know, why not own just 100 to 200 different growth companies instead of just buying just one? I mean, it makes sense. You know, Apple's got a price about $200, Nvidia's got a price about 150, 160, and it's growing and growing. But you could invest in some of these growth ETFs and you can have a piece of all of them all in one place. Now, all 3 of these ETFs are growth ETFs, so they're investing into companies that are innovating, creating, and growing for the future. That means you're going to have some tech giants, you're going to have some Mag 7 companies like Apple, Nvidia, Microsoft, Broadcom, Meta, and some of these companies are growing and growing and helping to grow the economy. Now, these companies are also going to be a little bit more volatile than blue chip companies, but that's the reason we're investing in them. They're going to have a little bit more risk, but we're also expecting to have possibly some more reward. So that's why you invest into these simple growth ETFs. Now, our first one's going to be SCHG. Now, SCHG tracks the Dow Jones Large Cap Growth Index. So it's got about 227 different holdings. It's got a low expense ratio and a pretty low price, and it's a great place to kind of buy and hold. It's got about 48% of its holdings in technology. So you are getting a good bit of technology in this ETF. Our next one is going to be QQQ. Now, QQQ is the Invesco QQQ Trust. It's been around for a long time. It's got a pretty good expense ratio, pretty high share price, unlike SCHG. It's got about 100 different holdings, which tracks the NASDAQ 100. So that means it is about 100 different companies on the NASDAQ, which is non-financial, and it's got a pretty good performance over the long term. The next one's going to be VUG, which is the Vanguard Growth Index ETF. Now, this has got about 169 different holdings, with about 49% being in technology. Now, this has got a low expense ratio, but it's still got a pretty high share price, if you ask me. So these companies in these ETFs are trying to track growth indexes and trying to provide its shareholders a great performance with growth stocks. Now, like I said, all of these have some of the similar companies. So if you were to pick 1 or 2 or 3, well, you're going to get the same thing. That's why we're going to break them down and see which one is the best for your portfolio. Now, let's talk about costs, because costs really matter. And when we're talking about investing our money, we want to see if we're getting the best bang for our buck. Now, the share price is going to differentiate between the two. QQQ is going to be on the highest range. It's about 560, 570, and it continues to go up. VUG is about that middle range with about $400 to $440 per share. And SCHG is the lowest, sitting at about $29 per share. Now, our next cost we have to look at is the expense ratio. So expense ratio is the cost to kind of manage that fund. And usually, since these are more passively managed, their costs are a little bit lower. So with QQQ, you're going to have about a 0.20% expense ratio, which means it's going to cost about $20 for every $10,000 invested. VUG is going to be 0.04%, so it's $4 for every $10,000 invested. And SCHG is 0.04%, which is $4 for every $10,000 invested. QQQ is the most expensive, but VUG and SCHG are the cheaper options, if you ask me. So if you're looking for a good share price, well, SCHG is the best share price of about $29, so you can get it in pretty cheaply. Those are just the prices of each and every one of these ETFs. So performance is something we have to look at too. Since we're investing our money, we want to see our money grow. And so with these ETFs, we're going to break down the performance based upon the year to date, 1 year, and even 10 years, just to see what we're seeing and what is probably possibly the best ETF for us to invest with. Right now, year to date, QQQ is up about 9%, VUG is up about 8%, and SCHG is trailing with about 6% year to date. Now, don't let those numbers fool you. Like I said, we're going to look at the year to date, 1 year, and 10 years. At 1 year, QQQ is doing about 13.5%, VUG is doing about 16%, and SCHG is doing about 14.5%. Right there, you see it that QQQ may be leading year to date, but VUG is leading in the 1 year performance, while SCHG is in the middle between those in the 1 year performance. At 10 years, we see that QQQ is doing about 18.7%. We're seeing that VUG is doing about 16.24%. We're seeing that SCHG is doing about 16.8%. So right there, QQQ is doing the best 10-year round, while SCHG is doing second best and VUG is doing third best. So we're looking at the performance overall. Like I said, QQQ is probably number 1. SCHG in the long term is doing number 2, and VUG is doing number 3. So those are some things you have to think about when we're looking at these 3 great growth ETFs. These all have some great performances, but if you're looking to track a good performance, I like to use Snowball Analytics. Snowball Analytics is one of my favorite places to track my portfolio. I've got my M1 Finance and my Vanguard portfolio connected to it, so I can look and see how my portfolio is doing over time. It gives me graphs and charts and even goals for me to achieve in my future for my portfolio. So if you want to learn a little bit more about Snowball Analytics, I'm going to leave a link in my description and a link in my pinned comments. Now, with these 3 great growth ETFs, we do have a couple of risks that come along with them. Number 1 risk is going to be tech concentration. Now, each one of these has a lot of tech in them. QQQ has about 53% tech, VUG has about 49% tech, while SCHG has about 48.7% tech, which is about 49% tech. So each one of these has a lot of tech into it, and that could be something that you may be looking at, and that could be something you want more of. And if you want more of, well, these 3 will give you a lot more tech. Risk number 2 is going to be concentration in the top 10, or the concentration in the Mag 7. So we have a lot of Mag 7. Apple, Nvidia, we have Microsoft, we have Amazon, we have Meta. These are all great companies that are part of these. Now, if we take a look at the top 10, QQQ's top 10 makes up about 50% of its portfolio. VUG's top 10 makes up about 57.7% of the portfolio, while SCHG makes up about 57.9% of the portfolio. So these top 10s are pretty concentrated, but QQQ has a little bit less concentration, even though it's got about 100 different holdings, while VUG has 169 holdings and SCHG has 227 different holdings. So the concentration is a little bit more in SCHG and VUG than QQQ. So that's got to be something to think about. Our last risk is there's no small cap exposure to any of these growth ETFs. That means when you see QQQ's only got 100 different stocks, well, there's no small caps. SCHG literally says large cap growth stocks, so no small caps. And VUG doesn't have many small caps as well. If the small cap sector of the market were to explode, well, these ETFs will not see the explosion within those portfolios. Now, we probably will see explosion overall because, I mean, if the market goes up, you'll see these tech ETFs go up as well. So that's just something to think about. Now, each one of these ETFs is different in a different way. They have similar portfolio exposures, they have similar stocks, and some of them even have a little bit of similar costs. So with QQQ, if you're looking at buying QQQ, you're looking at buying a little bit more concentration, 100 different stocks, which just tracks the NASDAQ 100. You're looking at more liquidity. So if people wanted to trade options and to sell covered calls and maybe some cash secured puts on QQQ, this is a great ETF to do it on. And if you're looking for a long-term performance, then QQQ could be that ETF. Now, QQQ does have some cons. Like I said, the cost, the share price is about $560, so it could be expensive. If you buy fractional shares, obviously you can buy pieces of it and continue to build upon that. Now, the expense ratio is 0.20%. A cheaper version would be QQQM, which is the same as that portfolio, but the expense ratio is 0.15%. So that is some things to think about. Now, if you're looking at VUG, VUG has similar performance as SCHG. It has a low expense ratio like SCHG at 0.04%, but the price is about $440. It is a little bit more diversified than QQQ with 169 different holdings instead of 100 different holdings, but the concentration in the top 10 is much more than the concentration for QQQ. So if you're looking for maybe a cheaper option, one with Vanguard, so more repeatable, if you have Vanguard, you can buy fractional shares of this. And if you're looking for something that has a little bit more companies than QQQ, VUG is a great ETF to hold. Our next one is SCHG. Now, SCHG has more companies than both VUG and QQQ. It's got a cheaper share price of $29. It's got a cheap expense ratio of 0.04%. So if you're looking for all that tech and growth as the other two, with a cheaper share price, a better long-term performance than VUG, so it's mixed between QQQ and VUG, and it's a great ETF altogether, well, SCHG could be that ETF for you. So we have three great ETFs. We have QQQ, VUG, and SCHG. That could be added to your portfolio, and you're looking for some more possibilities of growing your portfolio in a down market or in a bull market. Well, these are great places to kind of buy and hold. These hold companies that are innovating, creating, and trying to revolutionize our society. So where should you start? Well, start with one of these three and just continue to buy and hold for long term. You know, one may be more expensive. Well, if you can find a brokerage like Fidelity or even M1 Finance, you can have fractional shares. VUG, you can buy fractional shares on Vanguard. So that can be bought anywhere. SCHG, it's already a cheap price. So if you just have $29, $30, you can continue to buy one share at a time. Or if you have $100, that's about 3 shares at a time. So think about those. These are all great ETFs, growth ETFs to add to your portfolio. So let me know in the comments, which one do you like? Which growth ETF do you suggest I should talk about instead? And let me know in the comments and we'll start a conversation, and I'll see you in our next video.